Welcome to the September Spotlight on Investments, brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Investments is sponsored by Game Plan Financial Marketing, investing in you. For more information, please visit www.gameplanfinancial.com. Approximately $800 billion in total client assets will be transferred this year because of brokers and advisors switching firms, according to a recent study by Cerulli Associates, Inc. A large portion of the funds will be transferred between similar firms, as most advisors are expected to stay within the same segment of the industry. However, wirehouses could face a loss of $188 billion in assets, as brokers head to other channels, the study said. Meanwhile, insurance channels are expected to lose $13 billion, while regional channels will lose $6 billion. Duly registered advisors are expected to benefit most, receiving $60 billion in transferred client assets for the year, while registered firm advisors will receive $50 billion, and independent broker-dealers will see an increase of $50 billion, Cerulli said. Advisors are growing more confident as the effects of the recent recession begin to diminish, according to the Charles Schwab Corp.'s semi-annual Independent Advisors Outlook study. A survey of Schwab Advisor Services clients that made up part of the study found that 72% expect the recession to end in less than a year, while half believe it will be over by the end of this year. Meanwhile, 72% said they expect the S&P 500 to rise over the next 6 months, the highest mark seen in 2 years. In addition, 89% of advisors said they had gained new clients in the past 6 months, with 45% moving to RIAs from full-service wirehouses, and 23% coming from investors who previously used discount brokers. Despite the growing optimism, 57% said they worry about managing client expectations about investments, while 47% said they are adjusting to decreased revenue. Finally, exchange-traded funds were again the preferred choice of advisors, with nearly 40% intending to use them by the end of the year. Commodities came after ETFs in popularity, followed by real estate investment trusts and high-yield bonds. The Department of Labor is nixing a regulation issued at the end of the Bush administration that would have enabled advisors affiliated with mutual funds, brokerage firms, and other companies selling investments to offer investment advice to participants in 401k plans. According to Phyllis C. Borsey of the Employee Benefit Security Administration, quote, "We believe the final investment advice regulation published in the January 21st Federal Register went too far in permitting investment advice arrangements not specifically contemplated by the statutory exemption," unquote. The Obama administration, among others, has said that the rules would allow advisors who have a conflict of interest to provide investment advice. The rule had been delayed up until this point, although it is not yet known if the new administration will provide alternative rules. I'm Paul Wilson, and thanks for watching the Spotlight on Investments. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.